Welcome to Akesha's Foreign Exchange Made Easy class. Today is 24th session. Last day I have discussed Black and Scholes model and binomial pricing model. Today I will discuss on put call parity and solve some miscellaneous problem on call and put options. Come, put call parity theorem. The put-call parity theorem explains the relationship between call put prices and underlying price. Let us take an example. Current market price on underlying security is rupees 300 and put premium is rupees 4. The option expires in 3 months time. T is equal to 3 months, that is 0.25 year. The risk-free interest rate is currently 6%. For the strike price of rupees 250, the premium of the call option can be derived from the following formula. You should remember this formula. C minus P is equal to S minus K by 1 plus RT, where C is the call premium, P is the put premium, here it is rupees 4, S is spot price, underlying price, here rupees 300, and K is strike price, here rupees 250. Now put the value of P, S and K and R and T in the equation, that is C minus 4 is equal to 300, S is equal to 300, minus K 250 divided by 1 plus RT. R is equal to 6% and T is equal to 0.25. That is equal to C minus 4 is equal to 3 minus 200 by 1.015. That is equal to C minus 4 is equal to 300 minus 246.30, or C minus 4 is equal to 53.70, or C is equal to 57.70. So if you get the value of call option, you can find out the value of put option by using this formula, or vice versa. Next come another problem. In problem 1 of Black and Scholes, which we have find out, that is C is equal to 13.96 and P is equal to 4.576. From the given data, S is equal to 80, K is equal to 4.576, T is equal to 6 months and R is equal to 12%. Now taking P is equal to 4.756, we compute the call option price. Using the formula C minus P is equal to S minus K by 1 plus RT. That is equal to C minus 4.576 is equal to 80 minus 75 by 1 plus 0.12 into 0.5. That is equal to 80 minus 70 by 1.06. In this way, you find out C is equal to 13.826, where in the problem we have derived the value 13.96. In another problem, we have found C is equal to 34.77 and P is equal to 9.83. From the given data, S is equal to 185, K is equal to 170, T is equal to 6 months and R is equal to 12%. Now putting the value of this in the equation, C minus P is equal to S minus K by 1 plus RT, we get the value C is equal to 34.03. Now come miscellaneous problem of call and put option. Problem 1. That is, Mr. Roy wanted to buy share of Messrs. ABC Limited, which is expected to have a range of rupees 411 to rupees 592 in 3 months later. The spot price is rupees 421. His broker informs him that the price of the share can move up to rupees 522 within 3 months, so that he should buy a 3-month call of ABC Limited. In order to be prudent in buying the call, the share price should be more than or at least rupees 522, the assurance of which could not be given by the broker. Though he understands that the uncertainty of the market, he wants to know the probability of attaining the share price of rupees 592, so that buying of a 3-month call of ABC Limited at the execution price of rupees 522 is justified. Advising, take the risk-free interest to be 8% per annum and e to the power 0.02 is equal to 1.02. E to the power 0.02 means e to the power RT. R here is 8% and T is 3 months. So 8%, 8 into 0.25 is equal to 2%. So e to the power 0.02 will be used in the formula to find out the probability. Now you draw the diagram. Base price, spot price is 421 and upper limit is 592 and lower limit is 411. And you have to find out the probability first, that is in the upper side, 3 months interest rate is 2% and you get e to the power 0.02 is equal to 1.02, and here u is equal to 592 upper limit value divided by base price, that is 592 by 421 is equal to 1.406, and d is equal to lower limit value 411 divided by 421 is equal to 0.976. So the probability on upper side is equal to P is equal to probability is equal to E R to the power RT minus D divided by U minus D, that is equal to 1.02 minus 0.976 divided by 1.406 minus 0.976 is equal to 0.1023, that is equal to P is equal to 10.23%. So the question asks, the trader wants to know the probability of attaining the share price rupees 592. So the probability of attaining the share price 592 is 10.23%. Next problem. The current price of equity share of ABC Limited is 420, that is spot price. Within a period of 3 months, that is T is equal to 0.25, the maximum and minimum price is expected to be rupees 500 and rupees 400, upper limit value and lower limit value respectively. If the rate of interest be 8% per annum, what should be the value of a 3 months call option under the risk neutral method at the strike price of rupees 450? Given e to the power 0.02 is equal to 1.0202. E to the power 0.02 means e to the power 2%, that is derived from 8% into 0.25, that is equal to 2%. Now, risk neutral is the method of ascertaining probability of possible future outcome that have been adjusted for risks and this probability can be used to calculate the expected asset values. Now, the risk neutral method said that you should ascertain the probability on the upper side and lower side, and this probability will be adjusted to find the expected asset value, means call option price or put option price. Here you draw the diagram. S is equal to spot price is 420 and upper limit value is 500 and lower limit value is 400. First you have to find out the probability of upper side and lower side, and to do so that you have to find out the U. U is equal to 500 divided by 420 is equal to 1.1905. 1.1905, and D is equal to 400 divided by 420 is equal to 0.9523. Now the probability of the upper side is equal to P is equal to R minus D divided by U minus D. If you want to find out the probability in lower side, then you can use this formula U minus R divided by U minus D. Now come P on the upper side. E to the power 0.02 minus D divided by U minus D, that is equal to 1.0202 minus 0.9523 divided by 1.1905 minus 0.9523 is equal to 0.0679 divided by 0.2382, that is equal to 28.50%. That is probability on the upper side, and probability of the lower side will be 1 minus P of the upper side is equal to 71.50%. Now come value of the call option is equal to P into intrinsic value on the upper side plus 1 minus P into intrinsic value of the lower side. So here 0.2850, the probability of the upper side, multiplied with 500 minus 450. 450 is the strike price. That is intrinsic value will be 50, and in the lower side it will be 0 because 400 lower side value is less than the strike price 450. So the value of the call option will be 0.2850 into 50 divided by e to the power 0.02, that is equal to 1.0202 is equal to 13.96. The value of the call option is 13.96. Here you see the risk neutral method is applied first to ascertain the probability of future outcome, that is 500 and 400. First come, that is upper side is 28.50 and lower side is 71.50, and it is also used in the ascertaining the expected asset value, that is probability P into intrinsic value of the upper side 1 minus P into intrinsic value of the lower side divided by e to the power 0.02, that is 13.96. Next problem, Mr. X established the following spread on the ABC limited stock. Purchase 1 3 months call option with a premium of rupees 30 and an exercise price is 550. Purchase 1 3 months put option with a premium of rupees 5, exercise price is rupees 450. ABC Limited stock is currently selling at rupees 500. Determine profit or loss if the price of the ABC Limited stock remains at rupees 500 after 3 months. falls at rupees 350 after 3 months, rises to rupees 600 after 3 months. Assume the size option is 100 shares of ABC Limited. Now, you take the rupees 500 after 3 months. The trader will not exercise call and put option because call option price, strike price is 550, which is higher than the spot price after 3 months, and the strike price for put option is 450, and which is lower than the strike price after 3 months. So he will not exercise call option and put option. Only the premium paid will be the loss. The total premium paid on purchasing a call and put option will be rupees 30 for call option premium into 100 shares plus rupees 5 into 100 shares is equal to rupees 3,500. Now the first problem, when it is 500, trader will not exercise his right because in both cases it will be the OTM and the total loss will be rupees 3,500. When the spot price will be 350, then the trader will exercise the put option because the spot price is less than the strike price. The profit on the put option will be 450 is the strike price and the spot price is 350 into 100, that is equal to rupees 10,000. Less the total premium paid rupees 3,500. Net profit will be 10,000 minus 3,500 is equal to rupees 6,500. Now when the spot price becomes 600 after 3 months, then the trader will exercise call option, not put option, and the gain will be 600 minus 550. 600 is the spot price and the strike price is 550. It will be into 100 shares is equal to rupees 5,000. The total less total premium rupees 3,500. Net profit will be 5,000 minus 3,500 is equal to rupees 1,500. Now, next problem. You as an investor has purchased 4-month call option on equity share of ABC Limited of rupees 10, of which the current market price is rupees 132 and the exercise price is rupees 150. You expect the price to range between 120 and rupees 190. The expected share price of ABC Limited and related probability is given below. Expected price is rupees 120, 140, 160, 180, 190 and probability 5%, 20%, 50%, 10% and 15%. Total will be 1. Compute the expected share price at the end of 4 months. Value of the call option at the end of 4 months if the exercise price prevails. In the case of option is held to its maturity, what will be the expected value of call option? First, the expected share price is equal to sum of xi into pi. That is equal to 129 into probability 0.05 plus 140 into 0.20 plus 160 into 0.50 plus 180 into 0.10 plus 190 into 0.15 is equal to rupees 160.50. The expected value of call option will be 160.50 minus 150 is equal to 10.50. 150 is the strike price. If the option is held till maturity, the expected value of call option will be expected price 120. Now the value of the call will be 0 because he will not exercise his right. Probability is 5%, so expected value will be 0. And in next 140, he will not exercise his right, and probability is 0.20 and expected value is 0. In 160, the value of the call, intrinsic value is rupees 10, 50% is the probability, so expected value will be rupees 5. For 180, the value of the call option will be 30, 10% probability, so it will be rupees 3. And next 190, 40 will be the value of the call, multiplied with the probability, it will be 6, and total will be rupees 14. Next come, ascertain the value of option expiring 1 year later for the following securities. ABC is quoted rupees 110 at the end of 3 months. The stock price will be either rupees 100 or 150. Exercise price is rupees 120. 3 months option of MNC Limited carry on an exercise price of rupees 350. The stock price is expected to be rupees 250 or rupees 450. Presently, the share is traded at rupees 380. Risk-free interest rate is assumed 12% per annum for continuous discounting. Now, for ABC Limited, the strike price is 120 and the future price is expected to vary from 100 to 150. For rupees 100, the trader will not exercise his right because it is OTM. But for rupees 150, he will exercise his right because it is ITM in the money, and the value of the option will be 150 minus 120 is equal to 30. Now value of the delta option is equal to change in value in option and divided by change in future spot price. That is 30 minus 0 divided by 150 minus 100, that is equal to 60%. Now in amount to be invested in risk-free interest rate, discounted value of lower price of stock of rupees 100. The present value will be 100 divided by e to the power RT. That is equal to 100 divided by e to the power 0.12 rate of interest into 0.25 3 months. T is equal to 3 months. That is equal to rupees 97.04. Now value of the call option is equal to option delta into current stock price minus amount to be invested in risk-free interest. That is equal to option delta is 60% into current stock price is 110, discounted value is 97.04. That is amount to be invested is equal to 0.60 into 12.96, that is equal to 7.78 rupees. 7.78 is the value of the call option. Now, if you want to find out the put option value using the put call parity theorem, the C minus P is equal to S minus K by e to the power R into T is equal to S here is 110, 120 is the strike price K divided by e to the power 0.03. That is equal to 110 minus 116.45 is equal to minus 6.45. Now C minus P is equal to minus 6.45. So P is equal to C plus 6.45. That is equal to putting the value of C 7.78 plus 6.45 is equal to 14.23. For MNC Limited, the strike price is rupees 350 and the future price is expected to vary from 250 to 450. For rupees 250, the trader will not exercise his right because it is OTM, but for 450 he will exercise his right because it is ITM in the money. And the value of the option will be 450 minus 350 is equal to rupees 100. Now value of delta option, change in value in option divided by change in future spot price, that is equal to 100 minus 0 divided by 450 minus 250, that is equal to 50%, 0.50. Now amount to be invested in risk-free interest rate, discounted value of lower side of stock of rupees 250. 250 divided by e to the power RT, that is present value, is equal to 250 by e to the power 0.12 into 0.25, that is equal to rupees 242. Now value of the call option delta, option delta into current stock price, here it is 380, minus amount to be invested in risk-free interest, here it is 422.60, which is calculated here, is equal to 0.50 multiplied with 137.40 is equal to 68.70. Now you have to find out the put option, value of the put option using the put value parity theorem. C minus P is equal to S minus K by e to the power RT. Now S here is 380 and strike price is here 350. Spot price is 380 and strike price is 350 divided by 1.0305 is equal to 380 minus 339.64 is equal to 40.36. Now put value is equal to P is equal to C minus 40.36 is equal to 68.70, value of the call option minus 40.36, you will get the value of the put option 28.34. 68.70 we have already calculated here, 68.40, that is value of the call option. Next problem, stock of the ABC Limited is currently quoted at rupees 110. In 3 months, it could be either 90 or 190 or 135. Ascertain the value of call option with an exercise price of rupees 120 if the risk-free rate of interest is 8% per annum. Now here time is given, T is equal to 3 months, T is equal to 3 months, R is equal to 0.8. So you find out the RT is equal to 0.08 into 0.25 is equal to 2%, 0.02. Now stock price is 110, strike price is 120. 3 months time, the price of stock is expected to be either rupees 90 or 135. So you draw the diagram, 110 base price and lower limit value is 90 and upper limit value is 135. Now value of the call option will be 15, 135 minus 120, that is strike price, is equal to 15. Now you find out the probability of lower side as well as upper side. Now probability, before this you have to find out U, 135 by 110, that is lower side, sorry, it is upper side. 135 by 110 is equal to 1.23 and D is the 90 by 120 is equal to 0.82, it is lower side. Now P is equal to upper side probability is R minus D divided by U minus D, that is equal to e to the power 0.02 minus D divided by U minus D, that you have calculated this, you will find it 0.488 and probability on lower side will be 1 minus 0.488 is equal to 0.512. It is written here. You see the lower side value is 0.512 and upper side value is 0.488. Now value of the call option will be 15, that is call option at the end on the upper side, 15 into probability 0.488 minus 0 into 0.512 divided by e to the power 0.03 is equal to 1.0202. That is equal to 7.32 divided by 1.0202 is equal to 7.17. So the answer will be 7.17. Today I stop the class here. Next day this problem will be continued along with the problem of saddle. Thank you.